Welcome to another NEBA Spotlight. I am happy to present to you Marie. Marie, tell us about you. Tell us about the business.
So, just a little bit about me, and thank you so much for the introduction. My background is in engineering and Wall Street finance, and I spent most of my career developing software and architecting software. And right now, I'm involved with venture capital. I have gone through an accelerator called VC Lab, and I have a fund that I'm raising capital for, and it's called Infinity Path Ventures. And what I want to talk to everyone about today is the importance of venture capital. If I can just take a few steps back, and if we can recall the formation of our country, the United States, when our country was formed, um, a lot of people got involved in the formation of our country. And what do I mean by that? We actually got involved in the writing of our Constitution. We got involved in the writing of our state's Constitution. People organized and wrote petitions to do numerous drafts of our state's Constitution. And over the years, we've moved away from our different local organizations, right? And we've kind of abdicated that responsibility to lawmakers to work on our behalf. And hopefully we'll get back to that. So in terms of venture capital, it's the same way, right? We have let large corporations that are venture capital firms determine which companies to fund. And with that, venture capital is investing in the future. So, what is venture capital? It's a form of private equity where you have private financing for early stage companies that we think have a high potential, right? And we call those companies startups. And what do VCs get out of it? Well, they take an equity ownership in the companies that they invest in. And the way they get money out of it as those companies mature, they either get their money out when the startup has an IPO, or they can sell their shares through a private secondary market, or that startup gets acquired, and that's a chance for investors to get their money. Um, and so VCs play a critical role in funding innovation throughout the world, and they support entrepreneurs who have lack of access to traditional financing. Like a startup would not be able to get money from a bank. So that's where venture capital money comes in. And the structure of a venture capital fund is three separate companies. One is the fund company that actually deploys the capital into startups. Another one is the management company that does the day-to-day operations of a venture capital fund. And the other one is a general partner company. That's the company that makes decisions on which companies to invest in. And venture capital, like I said, is a driver of innovation. It provides capital for unproven but promising technologies, and it enables entrepreneurs to take risks and have breakthrough ideas. And this culminates um, in increase in capital coming into local communities. This is an increase in benefits to our society with breakthrough new technologies. And overall, it helps raise the GDP of nations because with new technologies, it brings about the creation of local economies. And it also creates high quality jobs. It drives technological advancement, and it generates wealth for investors and entrepreneurs. And it fosters entrepreneurial ecosystems in companies and also in universities. Um, and like I said, it contributes to the GDP. And what are limited partners? Limited partners are referred to as LPs. They're the people who actually invest in a fund. And these include institutional investors, family offices, high net worth, ultra high net worth, and angel investors. Um, LPs have a limited liability. Their only risk is the amount that they invest in the fund. They receive 80% of the fund's returns, which is a part of a standard 2 and 20 structure, which I'll get into. And general partners are the fund managers. They're the ones who make the investment decisions. And they receive 2% of the committed capital from the LPs as a management fee. And they receive also a carried interest, which is 20% of the fund's profits. And a startup company we know is a company that is doing something, building a product or service that is innovative. And there's different stages that VC firms invest in. There's a pre-seed, seed, Series A, Series B, and Series C, and beyond. Once you get to Series C or Series D, the company is ready for an IPO or is ready to be acquired. It's considered a late stage. And types of companies that VCs invest in usually are high growth technology companies or healthcare or biotech companies that are doing something innovative, software as a service, platform as a service, any fintech companies that are doing something novel with payment systems are also really popular, as well as consumer technology and e-commerce. And the fund, as I said before, earlier, it deploys capital into these various startup companies. And the goal is to have a very large exit. So the startups that you invest in, you want them to do well, and you help them to do well. And a management company, like I said, it handles the day-to-day operations. It's referred to as the manco. You have your general partner, that is the partners who actually decide which startup companies to invest in, the funds. Um, they decide which companies the fund is going to invest in. And here's some fund economics. The 2 and 20 model, I said the manager fee is at 2%. That's a 2. The carried interest is the 20% that is retained by the fund. And actually, that's accessible for the general partners. The LPs, they get 80% of the fund's profits. And here's just a little example of how that works. And carry is GP's share of the fund's profits. And the hurdle rate is just making sure that before the GPs are able to get any money, the LPs are paid back the money that they put in to the fund first. And there's a couple of different types of distribution. There's American waterfall distribution, which gives money back to the GPs on a per deal basis. And then there's a European waterfall distribution that waits until you get the total returns of the fund. And then only after that is calculated how much the GPs get. And this is the preferred way to get fund distribution, which protects the LPs. Otherwise, the LPs can try to claw back money if the fund loses money, and you want to avoid that. And then there's just some metrics to determine the fund performance. One is the internal rate of return, and another one is the annual rate of return. Most people go with the internal rate of return, and another one is the total value to paid in, which is the TVPI, and the other one is the multiple on investment capital, MOIC. Now, both of these have the same calculations, but it's just in the venture capital industry, people refer to the TVPI. And one other one is distributed to paid in. And how do you get involved? I would say your local community, organize hackathons, partner with universities, create or join the Angel Fund. And this is my contact information. And thank you for listening.
Awesome, Marie. This is wonderful. Definitely reach out to Marie to get more information. If there might be some kind of collaboration there. This is wonderful. We look forward to supporting you and your business, Marie. Thank you so much.
Thank you.